Efficient savings for the retirement planning, be well insured and, of course, at the same time use the advantages of the capital markets. That sounds like squaring the circle. Ideas on this topic now from Furio Pietribiasi, CEO of Mediolanum. Greetings to Dublin. Yeah, the stock markets are very volatile as we are currently experiencing. Why is it still a good idea to invest in the capital markets with unit-linked life insurance?
Well, we know that volatility is part of the cycle in capital markets, but we know as well that after volatility there is always recoveries. And that's exactly the value added of capital markets, particularly in a situation like today where there is a very high inflation and we need to protect our purchasing power in the long term, particularly for people saving for their pension and for their retirement. And therefore, capital markets and the capital appreciation can generate in the long term is the only way to achieve that.
But the combination of a stock savings plan and life insurance is nothing new, Furio. What are you doing differently now?
Well, this product and it's not just capital markets within an insurance wrapper. There is a service embedded there, which is Intelligent Investor Strategy, that is meant to generate value added for the investor in the long term. And that is the novelty. And that is something that has been proved historically very successful, particularly from the dollar averaging cost.
Does that mean maximizing the cost average effect in order to minimize emotions?
Well, clearly, emotion is a big challenge. We know that the outcome and good results and taking advantage from capital markets is not just from the solution itself. It becomes critical to have the right behavior. It's important not to sell when the market is going down and not to buy when the markets are going up. It's actually the other way around. It's being steady and holding the nerves when there is volatility, not selling and actually buying more. Because that allows to benefit of the dollar averaging cost. Obviously, timing is uncertain because you don't know what is the bottom of the market, which will be the most appropriate time to invest, and nobody can know that. That's why it's important to have a service that enables you to invest systematically into the markets. And when the markets are going down, depending if they're going down 5, 10, 15, 20%, doubles, triples, or quadruples, or quintuples the installment. By doing this, you maximize the dollar averaging cost. And that mechanism is the one that is generating the value. And the objective here is not to maximize the return, but to maximize the probability of making money. And that's the most important thing, because by doing this, you increase your probability to build this capital appreciation over the long run, over the long term, and achieving your investment objectives.
However, circumstances can change at any time. How flexible is the concept for the customers?
Actually, the dynamics and how is built, the mechanism allows not only to invest when the market is going down, but as well as taking profits when the market is going up. And automatically takes the profit and switches the money into a low-risk, short-term Euro fixed income fund in such a way that the risk is lower. So the dynamic and the benefit is not just entering into the markets, but is also taking an advantage of the upside of the market and to save some money in the low-risk fund that will again be reinvested when the market will be turned to be volatile. Because as we know, this is a very long-term product, so it's long-term horizon. And in the long term, usually you may have one cycle or two cycles of financial markets. And that's why it's important the flexibility embedded of the product. On top of clearly having the ability to switch and change the target insurance funds where somebody wants to invest.
You also have an eye on the tax advantages of this solution. Can you tell us more about it?
Well, the benefit of this is the fact that it's an insurance product. Therefore, it means that you have 50% of tax advantage on the capital gain. So you pay only the capital gain on 50% of the product. And if you stay invested at least 12 years and you are over 62, then is fully tax-free. So it's a big advantage and it's very important for a client as the objective in the long term. And in the meantime, all the switches that are happening across the products, they're not subject to taxation. and therefore you fully take an advantage of the capital that you have invested.
And finally, what are the advantages for the independent financial advisors?
Actually, the advantage for the independent financial advisors are two. Number one, they are able to explain to the client at the outset, at the very beginning, how the volatility will be used in the interest and in the advantage of the future outcome for the client, which becomes critical. Second of all, is going to enable the financial advisor to manage and handle a large number of clients. And so they don't need to call each client and to convince one by one that is the right time to invest because of volatility, but simply is already the mechanism that is doing it. It's impossible for a financial advisor being able to catch the timing and being able to advise a large number of clients when markets are very volatile and volatility and the movements are very fast. This is its perfect solution to provide value-added, high-touch service to investors, particularly for the financial advisor that have a large number of clients.
Thank you very much, Furio Pietribiasi, CEO of Mediolanum.